Hi guys, my name's Tim, and today we're going to talk about the Bitcoin cycles and what causes them. I actually produced a video explaining this, and I probably went into too much detail. I went off on a large tangent, so I'm going to keep this one super concise, and then you can watch the 13-minute video for the more detailed analysis, and then I'm planning to produce much more videos where I go into lots and lots of detail about the history of Bitcoin and the history of the markets and how they interrelate. It's fascinating. Super excited to share these details. So this will be the condensed version. So a lot of people think that the Bitcoin halving plays a big part in the Bitcoin cycles. I've got the Bitcoin halvings here, these red dotted lines. And you can see there seems to be a correlation. So every time there's a halving, there's a big spike. Halving, spike, halving, spike. Now we've only had three. So there's only three data points. But I think that something else may be causing the Bitcoin spikes. And it's not the Bitcoin halving. It's got nothing to do with the Bitcoin halving. The halving might have 5% to do with it. I think what's causing it is actually the natural market cadence itself. And I've got 100 years worth of data here to prove this fact, or to present this theory. Okay, so quickly in a nutshell, this is the Dow Jones, and just to give you an idea, for those that don't know what the Dow Jones is, because I know a lot of people are focused on crypto. So Dow Jones is basically some of the 30 largest companies in the world. Companies like Apple, Boeing, Microsoft, Coca-Cola, they're the big blue chip companies that survive and thrive, basically. It gives you a really good indication of the market as a whole. Okay, so based on that, let's have a look at, this is 100 years worth of the Dow Jones data. Now, this is a condensed version. I'm going to start from 1950 and to the current day. And what I've overlaid is, I've actually put this is the 31-month moving average. I meant to put 30 months, but it was a bit of a typo, but it won't make much difference. What you can notice here is that every 4 years, we bounce off this moving average. This is a natural cadence in the market as a whole. This has been going on since 1950. And if you look here, this is the current era from 2008. We've bounced off it every 4 years. And we probably will bounce off it again in 2024, and then we'll bounce off it again in 2028. Now, we can't predict the future exactly, but we can use these trends to show that, well, this is what's been happening for the last 70 years, okay? Now, it's possible that we end up having a big depression or some crazy crash. It may happen, may not happen. I'll produce videos on that soon. But for the most part, the default is we bounce off it every 4 years. Now, if I zoom in here, here's a close-up of the sort of 1950s period. You can see it just bounces off it perfectly. It extends, comes back. There's this momentum where it extends, comes back. It extends, comes back. Sometimes it drops further than it should, but so that it rebounds just really, really strongly as well. Now, let's jump back into Bitcoin. It's Bitcoin. These dotted blue lines are when the market has touched base, has corrected, has bounced off. The Dow Jones, the market in general, has bounced off. Now, you have to remember that Bitcoin is just one asset. It's one asset within a big market. So think of it as a shopping mall. Bitcoin is one of the shops in a shopping mall, but the overall market is the shopping mall itself, okay? So if all of a sudden you turn all the lights off in the shopping mall, it affects all the shops. And if all of a sudden you advertise the shopping mall and everyone goes to the shopping mall, all the shops will benefit. So Bitcoin is in the scheme of things, it's actually not that big of a shop. You've got the big retail shops, and then you've got the smaller shops, and Bitcoin's one of the smaller shops. Anyhow, so Bitcoin every 4 years, my theory here is it bounces off. It gets momentum from the markets in general. So in summary, it's not the Bitcoin halvings, it's the natural market cadence that's been happening for 70 years. And yes, the Bitcoin halvings also occur at roughly the same time. So we can see how there is also appears to be a correlation with the halvings. Maybe the halvings have some sort of impact as well. But there's so many different cryptos that also improve over this time. We know Bitcoin. Brings those ones up. It brings the other cryptos up with it. I think there's a really strong relationship between the alts and Bitcoin. They need each other, essentially. But that's a story for another video. So yeah, causation does not equal, well, correlation does not always equal causation. However, I think it's more likely, given all the markets do well every 4 years, they bounce off every 4 years. I think that is what's causing Bitcoin, especially considering Bitcoin is a smaller asset compared to a lot of these markets. So that's my end of my short video. Hope you enjoyed. Don't forget to like and subscribe. I'm hoping to produce much more content in the future. So excited. I've got so much information that I want to share based on all the evidence, the graphs, and the trends. So stay tuned. I'm Tim, and I'll see you next time. Cheers.